Hi, I'm Chelsea from Bezla. We can think of hotel revenue management strategies as assertions of how rates will be used to achieve marketing objectives. They provide the general guidelines for a hotel's revenue management decisions over time. The choice of strategy brings in a longer range operational perspective of perhaps 3 to 5 years and serves to coordinate and organize hotel revenue management activities. Pricing strategies tend to be based either on costs or markets. The cost emphasis often results in hotel rates being set by formula. Fixed and variable costs per unit are determined, and a markup is added. In the restaurant industry, wines may be priced at a certain percentage over cost, and meals at a given multiple of food costs. An alternative cost-based formula is the general rule of thumb in the hotel industry that room rates should reflect about $1 for each $1,000 it costs to construct the room. If rooms cost $100,000 to build, the room rate is calculated at $100. In establishing these relatively simple rules for determining prices, a number of assumptions have to be made about the behavior of costs and the willingness of guests to pay the resulting room rates. In many hotels built over the last few years, construction costs have increased faster than the capacity or willingness of guests to pay, with some rooms costing in excess of $500,000. Meeting these costs and the costs of providing the service that guests expect leads to long-term loss situations. It is sometimes said that the third or fourth owner of a hotel is the one that begins to profit. Cost-based hotel revenue management leads to a very frequent pricing error made by hotel companies. That is, setting prices high enough to make sure all costs are covered. In so doing, important demand factors are ignored, for costs replace guest reactions as the overriding pricing guidelines. When such cost-based prices deter guests from purchasing, profit targets are not met, and total costs are in fact not covered. Where hotels have excess capacity, management may be tempted to ignore fixed costs in setting room rates. They may reason that it is better to make sales at rates that cover total variable costs and perhaps a little more than not to make sales at all. Costs are often seen as being the sole or main room rate determining factor. However, costs themselves, as we have seen, may be dependent on price. When rates are charged that significantly increase volume, then overhead costs per unit are reduced, and rates in turn can be lowered while profit margins actually increase. If the cost of staffing room service or a 24-hour coffee shop are spread over a large volume, the per guest costs are relatively low. But if only 1 or 2 guests are served, the overhead cost per guest may even become prohibitive. If Bezla could be a service for your hotel marketing, call us at 888-999-8086 or visit us at bezla.com.